Good day everyone. Welcome to ESR-REIT's financial results for the first half of 2021. I hope all of you are keeping healthy and safe. Our first half 2021 performance reflects a relatively stable operating performance, underpinned by a robust all-round execution of our business strategy, providing a strong balance sheet with significant liquidity, stability, and financial resources to position ESR-REIT for eventual economic recovery. Despite the continued uncertainties over COVID-19, our stabilized portfolio provides a strong platform for us to continue pursuing growth opportunities to strengthen our portfolio through asset enhancement initiatives, value-accretive acquisitions, and divestment of non-core assets. First, I would like to start by sharing some financial highlights. Our DPU for the first half of 2021 increased by 14.3% year-on-year to 1.554 cents due to higher net property income, primarily from the absence of provision for COVID-19 rental rebates in the first half of this year. Our DPU for second quarter of 2021 increased 13.9% year-on-year from 0.662 cents to 0.754 cents, out of which an advance distribution of 0.41 cents for the period from 1st of April 2021 to 17th of May of 2021 had been paid on the 17th of June this year. This advance distribution was made in connection with our $100 million private placement, which was completed on the 18th of May this year. An increase in DPU is driven by an all-round increase in gross revenue, lower property expenses, and lower borrowing costs. Gross revenue for the first half of this year grew 5.4% to $119.8 million, and net property income for this first half rose 8.4% to $87 million, respectively, on a year-on-year basis. The increase was mainly due to the absence of provisions for COVID-19 rental rebates and lower property expenses in the first half of this year. Accordingly, the amount available for distribution for this first half was up 18.7% year-on-year to $56.8 million, driven by higher net property income and lower borrowing costs. Rental collection for the first half of this year was 97.9% of total receivables, in line with pre-pandemic levels. Given that Singapore has recently tightened measures under the Phase 2 heightened alert, we provided rental rebates to some retail and F&B tenants in the second quarter to ease their businesses and cash flow pressures. Such rental rebates were part of the provisions made in the financial year 2020. Moving on to operations. Portfolio occupancy increased from 90.8% in the previous quarter to 91.7% in the second quarter of 2021, consistently above JTC's average of 90%, due to the completion of the acquisition of 46A Tanjong Penjuru and an improvement in overall portfolio occupancy. During the first half of this year, a total of 1.08 million square feet of space was leased, comprising 500,000 square feet of new leases and 585,000 square feet of lease renewals. Rental reversion for the second quarter of this year was minus 0.2%, with the year-to-date rental reversion at minus 1.6% as at 30th of June 2021, primarily due to lower renewal rates for certain large business park tenants in the first quarter of 2021. Despite the flattish rental reversion in the second quarter, the high-specs industrial, logistics and warehouse, and general industrial sectors registered positive rental reversions in the second quarter of this year. The weighted average lease expiry of the portfolio was 2.8 years. We will continue to strive to achieve an optimal balance between improving occupancy levels and maximizing returns from the portfolio. We have recently completed the DPU accretive acquisition of 46A Tanjong Penjuru for $124.7 million, a modern, in-demand ramp-up logistics facility in Singapore. In addition, we have also completed our first overseas acquisition of a 10% interest in ESR Australia Logistics Partnership from our sponsor, ESR Cayman Limited, signalling the beginning of our overseas expansion. Two high-specs industrial properties, 16 Tai Seng Street and 7000 Ang Mo Kio Avenue 5, will begin undergoing AEI works in the second half at a total estimated cost of $79.2 million. For 7000 Ang Mo Kio Avenue 5, the asset enhancement initiatives will comprise the development of unutilized plot ratio, adding approximately 265,000 square feet of gross floor area. We are also on track to obtain temporary occupation permit for 19 Tai Seng Avenue in the third quarter of this year, having secured over 63% committed occupancy thus far. At the same time, we have divested 2 non-core properties, 3C Toh Guan Road East and 11 Serangoon North Avenue 5, for $53 million at a 5% premium to the aggregate fair value. Moving on to capital management. Our portfolio remains 100% unencumbered with a gearing of 42.9%. Our all-in cost of debt has been further reduced to 3.24% per annum, with 75% of our borrowings on fixed interest rates over the next 2.1 years. During the first half of 2021, we announced an equity fundraising exercise comprising a $100 million private placement and then up to $50 million preferential offering to raise gross proceeds of approximately $150 million. The private placement was 3.4 times subscribed with the upsize option exercised, and the preferential offering is expected to be launched at the extraordinary general meeting scheduled on the 26th of July 2021. Post completion of the preferential offering and assuming the proceeds are fully applied towards debt repayment, the aggregate leverage will be reduced to 41.3% on a pro forma basis. Following the successful refinancing of all expiring debt due in this financial year, ahead of expiry, we have no further refinancing requirements for the rest of the year. We will continue to actively manage our debt structure, including assessing early refinancing options, and may even consider tapping the bond market if the terms are reasonably attractive. Creating a platform that delivers sustainable long-term returns for investors and positive outcome for other stakeholders has always underpinned our business strategy. The impact of COVID-19 is likely to be ongoing, limiting economic activities for the next 18 to 24 months. With a stable portfolio focused on high-value sectors, we are uniquely placed to benefit from the ongoing shift in consumption patterns across the industrial space. The pandemic is accelerating this shift, with businesses responding to the challenges and opportunities of a digitalizing industrial landscape. Our focus will be to ensure that our properties remain relevant and future-ready for the industrialists. While we will remain cautious for the rest of the year, we are confident with our portfolio and the right strategy for any challenges ahead. With that, thank you very much for watching. Stay safe, stay healthy. We look forward to seeing you again.